Hello, everyone. Looks like we have a big group today on the webcast. And as Amy mentioned, please ask your questions. I might not be able to get to all of them today, but we'll do so after the webcast. So let's move on. Just quickly, a couple of words about me. Ksenia Popke, I'm a partner in charge of the not-for-profit practice here in Colorado. And I currently sit on the technical issues committee for the firm, as well as represent the firm at AICPA level. At the AICPA Not-for-Profit Council, we're a membership group that is responsible for the not-for-profit section of the AICPA, which houses a lot of resources. If you're not a member, I would highly encourage you, and I will also show you where to enter that. So let's talk about today. We have some accounting standards to cover and talk about how these newly effective accounting standards will impact your organization in the upcoming year, and also talk about some of the key changes that have occurred in the auditor's report when the new suite of auditing standards was issued that will be effective December 31st, 2021. So you probably have seen this slide before if you have watched any of the FASB or AICPA webcasts that were recent, or maybe even attended the AICPA Not-for-Profit Council this past summer. There were three large standards that were issued, not just for not-for-profits: revenue, leases, and CECL. So revenue recognition under Section 606, leases 842, and CECL 326. I'm going to give a brief update on these, because revenue was actually covered in our previous webcast. So if you were not able to watch that, please obtain maybe a recording. It was a full hour on revenue recognition, both overall revenue recognition for service type of contracts, but also not-for-profit specific revenue recognition. Leases, we'll talk a little bit about it today, and mainly as it pertains to some arrangements that you might be able to see in the not-for-profit world more often, such as below market leases. And CECL is a standard that is not going to be effective for a couple more years. I'll give a quick brief overview, but there will be other sessions on that specific standard as we move along. So this particular slide shows all of the different dates that are effective for these standards. For the revenue, you'd see calendar year 2020 for non-public entities. For the most part, most of our clients have already adopted the revenue standard. Maybe if you're a September year-end or a November year-end, you're still in the midst of adopting the standard as you go through the audit. The leases, because of COVID, there was some deferrals issued, and leases will be effective for calendar year 2022. So if you're a fiscal year, you'll be looking at implementing this particular standard for your 2023 year end. And as I mentioned, CECL is a little bit further out for calendar year 2023. For the most part, I will be concentrating on the standards that are effective for non-public not-for-profits. The public not-for-profits are those with publicly traded debt, so sometimes called conduit debt, direct debt. And for the most part, the public not-for-profits have already implemented some of these standards, including leases. One thing to note, though, there was a new standard issued, ASU 2018-08, clarifying the scope and the accounting guidance of contributions received and contributions made. That particular standard was not deferred as part of the suite of standards that was deferred because of COVID. So again, for the most part, the ASU 2018-08 was already implemented or is just being implemented currently by some of the calendar year clients. So one thing to note, I wanted to provide the group with some resources of where to look at, maybe just a quick glance of what standards are out there and what are some of the projects that FASB has taken for not-for-profits. This is a snip from FASB's website. If you go to that and look at quick links on the right-hand side, there is a section devoted to not-for-profit organizations. So if you click on that, you will be taken to the not-for-profit page of FASB that has a lot of resources, meeting minutes for the not-for-profit advisory committee and so forth. But there is a section on recently issued accounting standards updates. And these particular standards, you won't see the revenue recognition here or the Leases standard, because those are much broader in its coverage. But this particular page will show you some more specific not-for-profit standards that have been issued. So kind of starting from the bottom, presentation of financial statements of not-for-profit entities, ASU 2016-14. For the most part, all not-for-profits have now implemented this standard. I think the users are getting more and more comfortable with the way that financial statements of not-for-profits are presented, where temporarily restricted and permanently restricted net assets have been combined into with donor restrictions, the addition of liquidity footnote, and so forth. So this particular standard was a fairly significant undertaking for FASB and one of their larger projects. The revenue recognition of grants and contracts by not-for-profit entities, so ASU 2018-08, we covered that in our previous webcast on revenue recognition. Again, this particular standard has now been effective for all entities. And I would say that that standard did have some impacts on not-for-profit organizations that held a lot of grants and particularly contracts from federal government on how they were recording revenue, whether it was deferred or recognized in any specific year. Then the next standard that was issued, not-for-profit entities updating the definition of collections. That particular standard will be is actually effective now, and we'll talk about it. I'll give you a really brief overview. Not a very long standard, mainly affecting museums and organizations that are holding collections. This particular standard, even though it applies mainly to not-for-profit organizations, all of the entities that hold collections are within the scope of the standard. The next the next standard here, intangibles, goodwill, and other business combinations and not-for-profit entities, extending the private company accounting alternative on goodwill. So a couple words on that. In 2014, FASB issued an accounting standards 2014-02, intangibles, goodwill, and other, and then 2014-18 for business combinations. And those two standards actually simplified the accounting for goodwill and the accounting for certain identifiable intangible assets, but only for private companies. And with this particular topic 350, ASU 2019-06, the standard actually extends the private company accounting alternative for goodwill to not-for-profit entities. And not-for-profits are now allowed to amortize goodwill on a straight line basis over 10 years or less than 10. And it's also simplified some of the impairment testing for those not-for-profits that hold goodwill. And then the last item on this slide is not-for-profits is the presentation and disclosure for contributed non-financial assets, or the in-kind standard. This is the most recent standard that was issued for not-for-profits specifically, and we'll talk about it, but we will also cover this particular standard in a lot more detail because it is so broad-reaching. Almost all not-for-profits receive some type of in-kind contributions in their operations. So this particular standard we'll cover in our third series of technical updates this fall, so be on the lookout for that. So as I mentioned, these are more specific not-for-profit standards, but we will go through and look at leases as it pertains to not-for-profits as well. So just a couple of terms here on this slide. A lease is defined as a contract that conveys the right to control the use of a specific asset for a period of time in exchange for consideration. A couple of things that are very important in this particular definition. First of all, an asset needs to be an identifiable asset, and there needs to be a consideration as an exchange, because promises to give, whether they're of promises to give the use of long-lived asset or promises to give of cash and other financial assets, is also a contract. But in that particular situation, a promise to give does not consist of consideration. So whenever you look at a contract to either use the assets or receive the control of the assets, you need to be looking for that key element of consideration. Promises to give are still considered outside of the lease standard. So as long as there are no lease payments, even though an organization is using the assets or the premises, there is no lease. And we'll walk through a little bit more through an example of below market lease, because typical leases are very common. There's been a lot of webcasts and information provided to organizations over leases. If you're interested in hearing more about just the lease standard in general, we're doing a 3-part series of accounting and auditing update for the firm and for our clients. The first session will start this Thursday, and it will have a much deeper dive into the standards. The presentation today is really more focused on items that might be different for not-for-profits and the accounting. So below market leases is one type of lease where the organization receives not only a contribution of the portion fair market value in excess of the consideration that they pay, right? But they also sign a contract where they are providing some lease standards. So you could see here that when the lease agreement's lease payments are below the fair rental value of the property, there may be partial donation from an inherent contribution. So always be on the lookout for leases where a donor may provide that inherent contribution and the organization is actually paying of a consideration that is much below the market value. And we'll walk through some of the specific example here. So let's consider where a donor provides a not-for-profit with a discounted use of equipment for 3 years beginning January. There's no options for renewal, there's no transfer of ownership, and the economic life of the equipment for 3 years. The agreement that the donor signs with the organization provides the equipment at $15,000 per year, but the fair value of the total rental is determined to be $100,000 over 3 years. And it changes every year. So 31,000 in year 1, 33 in year 2, and 36 in year 3. But the organization is only required to pay $15,000 per year to the donor, so approximately $45,000 in total. So when you consider the total consideration paid of $45,000 and the fair market value of $100,000, you have an inherent contribution that is embedded in this lease. But how do you account for that? So this is kind of a quick example of some of the actual accounting, and then we'll also have some journal entries at the end to help organizations walk through this standard. But if you look at the total value of the lease, the $100,000, it is split between the consideration, the actual cash out the door, and the portion that would be considered contribution that is actually changing every single year. Then you would calculate the present value of both the right of use asset and the lease liability, and you would calculate the present value of the contribution that would become your promise to give or contribution receivable, and would also have an impact on the net assets because of the time restriction that is embedded in this particular promise to give. So looking at the actual journal entries that would be recorded here. Actually, journal entries would be on the next page, but this is kind of a summary of similar information of how the lease liability right of use asset would be amortized. And you could see that the interest and the lease payments that would be diminishing the liability do not equal the right of use asset, because right of use asset would be depreciated on a straight line basis, where the lease liability is being amortized using the effective interest rate. But at the end, both are amortized to zero. So in any given year, there are slight differences between the lease liability and the right of use asset. For the promise to give side, again, there is no amortization in year one, and that is specific in the standards that you do not discount promise to give payments that are supposed to come in the next year. And so there is no amortization in year one, but there are amortization of discounts in both year two and year three, with the actual consideration that's above the cash payment, right? This is your portion to be amortized every single year for the contribution element. And so your contribution receivable, again, will over 3 years amortize to zero. But you could see that in any given year, all of these numbers would be different. And then some examples, and I know that Amy will send out some of the information for these slides. So if you actually want to trace some of these journal entries going back to the examples, you are more likely very happy to do so. So right of use asset lease liability recorded in year one, promises to give, and again, it's going to be a restricted in-kind contribution recorded in year one, and some of the other entries that are on this page. So amortization of the right of use asset, lease liability. And here I'm actually presenting you with the example of a journal entry you would record for the second year of the discount, because again, during the first year, promises to give are not amortized. Okay, so that's as far as just a really brief overview of an example of a lease standard and how it would apply for a not-for-profit with below market lease. The next standard we're going to talk about is the reporting of gifts in kind. And as I mentioned, this particular standard will be covered in a lot more detail with a lot more examples at the next webcast. I will just give a very quick summary. So current GAAP prior to this amendment does not include specific presentation requirements for contributed non-financial assets or specific disclosure requirements for contributed non-financial assets other than contributed services. You've always had to disclose contributed services, but not necessarily anything else. The amendment does not create new recognition requirements or measurement requirements necessarily, but it does provide for additional disclosures. The objective of the standard was really to increase transparency about types of in-kind contributions that the organization receives. And the scope of this particular standard are non-financial assets, so fixed assets, use of fixed assets, materials, supplies, intangibles, but not financial assets. You will not see the, for example, stock contributions as part of the scope, because there's already guidance out there that handles the contributions of financial assets. So why was this standard issued? Why was it so important? For the most part, many not-for-profits receive and use significant amounts of gifts in kind. It could matter quite a bit what type of in kind the not-for-profit receives, because not only that it could have a significant impact on key metrics, for example, such as program expenses, but could also have implications for the programmatic sustainability, because if the level of gifts in kind decreases significantly, a not-for-profit must decide whether to spend other resources to make the difference and actually purchase the materials that were not donated in that particular instance, or actually pare back some of the programs. So there was a lot of discussions at the FASB level of whether or not this standard was needed, and the consensus was that because this standard covers such a large portion of not-for-profits, that some clarity and additional disclosures was needed for the public. So some key considerations here. There will be a requirement to separately present all the in-kind contributions as a separate line on the statement of activities, so that it's very clear of how much the organization receives right from the standard, right from the statement. The effective date for this particular standard is for annual periods beginning after June 15th, 2021, which puts June 30, 2022 fiscal year and as being the first fiscal year of implementation. This particular date is a little bit different than what you would see in other standards, where typically FASB has a December year end as their key implementation date. But again, because this standard covered so many not-for-profits, and not-for-profits, a lot of them have the June 30 year end, FASB decided not to delay the implementation and jump right into it. So for those organizations with June 30 year ends, you're technically already in the year where the standard would be effective for you, and the information will be audited at your next June 30, 2022 fiscal year. So some of the new disclosure requirements, you're now required to present information about non-financial assets and whether they were monetized or used during the reporting period, and I'll have some examples of how that will look. You will have to disclose a policy about monetizing contributed non-financial assets. And so that's another thing that organizations may consider looking into, to review the policies for in-kind, consider updating them, working with the development department on tracking the in-kind contributions, maybe in slightly different manner than it has been done in the past, so that this particular footnote disclosure could be put together fairly easily at the time of the final financial reporting. Description of any donor imposed restrictions will have to be done, again, by type of asset, not in total. A description of the valuation techniques, and we'll go over a few of them. And then kind of a new concept for disclosures in the in-kind world is the principal market or most advantageous market used to arrive at that fair value. The principal market would be the market with the greatest volume and level of activity for the asset or for that asset. So for the most part, a lot of not-for-profits, a lot of our clients operate locally in the United States, and the potential valuation between geographic markets might not differ materially. But if you think about some of the larger not-for-profits that also operate globally, and especially in the pharmaceutical industry, where the fair value of a vaccine in a region somewhere in Africa might be quite different than the fair value of that same vaccine in Seattle, that would actually have a significant impact on the financial statements if the principal market fair value was to be used versus just the local market of where the not-for-profit is incorporated. A couple presentation examples. So as I mentioned, a separate line item. So in-kind contributions, some could be with donor restrictions. Mostly probably you will see that the in-kind is coming without donor restrictions, but this is a new requirement to have it completely separated. So for now, if you have in-kind contributions in your GL, all summed into a total contribution account, probably something you might want to consider tracking separately. This is a different presentation of this similar information where without donor restrictions and with donor restrictions could be broken out between in-kind and other. I don't anticipate seeing this example as much from what I've seen AICPA put together as examples for this particular standard. Most organizations, I think, will keep the different row instead of adding additional columns for the in-kind. So a couple presentation examples here for disclosures of, so the 548,000 is what we saw in the previous slide. That particular amount is broken out by various categories: building, supplies, food. You do have to disclose what programs and activities that particular in-kind contribution was utilized in. So various activities, animal shelter. And then, oh, doctor imposed. Well, hopefully it's donor imposed, but for veterinary supplies, maybe it is doctor imposed. So sorry for that. I just saw that. So again, are there any donor imposed restrictions on that particular bucket of your in-kind contributions and the valuation techniques that you have to actually disclose explicitly in your footnotes? Different type of narrative examples. Again, as on the previous slide, it said that the qualitative information will have to be identified in the financial statements. So not only that there will be a tabular presentation of breaking down all of your various types of in-kind, you will have to actually write something else. But this is just a narrative example. The previous example is also allowed because this information is also covered as far as restrictions in the valuation techniques. But here's some more examples on how this might actually look in your financial statements. So the valuation techniques and the donor restrictions, whether or not any of it was restricted. A couple, just again, I'm going to go through some of these examples, but they will be available in the slide deck. So if you have vehicle donations, what this might look like. If you have services, again, the disclosure for professional services has always been there in the in GAAP, but this is an expanded type of disclosure for both services and materials. So when we're looking at the principal market, again, here's some valuation techniques, but also, where was the medicine actually valued at? So for those that are not legally permissible for sale, the organization used third-party sources representing exit prices in the developing markets. So this is something that will, I think, have a pretty significant impact on the larger not-for-profits when a very specific market is to be used for valuation techniques instead of just the US. Okay, so this is the last slide on gifts in kind. And as I mentioned, we will be going through a lot more detail. There is a whole hour webcast dedicated just to this standard because of how broad it is and how many not-for-profits it will affect. But do remember that policies will have to be disclosed. So if your organization currently does not have a policy on in-kind, you still have some time to put something in place. We have lots of examples. So if you're a client or a prospect, please reach out to us. We're very happy to help put some of these policies in place and work with your boards on that. Okay. So another standard that I mentioned in the beginning on the FASB slide is the ASU 2019-03, updating the definition of collections. So for the most part, this particular standard will apply to fairly small subset of not-for-profits, museums and botanic gardens and so forth, those organizations that actually hold collections. And FASB decided that they needed to align the definition of collections with those used in the industry, used by Association of Museums. And the key terminology here is that this particular ASU amended the master glossary for the term collection. And in red here in the last paragraph is that these collections are subject to an organizational policy that requires the use of proceeds from items that are sold to be used for acquisition of new collection items and direct care. So in the past, this particular standard did not include direct care as part of the definition, and therefore the proceeds from sales of collections were only allowed to be used for purchases of additional collection items. But now that particular terminology has been extended to include direct care. And you'll see that, again, if you're an organization that has collection If you have a policy that allows the proceeds from deaccessions or sold collection items to be used for direct care, that particular policy needs to be disclosed, but also an organization needs to disclose its definition of direct care. The standard did not actually specify what direct care means and did not provide that definition. That's why this particular disclosure requirement was set in place, that if an organization will be using the proceeds from its collection items for direct care, they need to actually define what direct care means for that particular organization. There were some examples given in the commentary to the standard and so forth, but some of them would include expenditures that enhance the life of the collection, that provide benefit to the collection. But the key thing is that direct care excludes expenditures that are regular and ongoing in nature, such as routine maintenance for the collection. So just for those of you on the call that might have collection items, again, if you don't have a policy, that is something to potentially start looking at. The next few slides will cover several standards that are either effective for this year with December 31st, 2021 year end, or the ones to think about going forward. And I just have a slide each, as there were quite a few issued. You can imagine FASB is busy. There's been a lot of standards issued. So the ones that I will be talking about, just believe that they will actually impact not-for-profits, even though they were not specifically listed as part of the not-for-profit FASB's project. One of them being intangibles, goodwill, and other internal use software, and customers accounting for implementation costs incurred in a cloud computing arrangement. So this particular standard is effective December 31st, 2021. And I think a lot of organizations are finding themselves in this particular area of potentially changing technology, implementing new software, and a lot of the software being used by organization is in the cloud computing environment. And so FASB really thought that it would be important to address those type of arrangements. The standard permits the capitalization of implementation costs related to the application development stage for both license and service contracts. But you're not allowed to capitalize expense of those costs that are associated with the preliminary project and then post-implementation stages. So for example, after the implementation has been completed, if you are providing training to your employees on how to use the particular standard, or you're still converting some of the data from one system to another, those costs must be expensed. There is some data conversion allowed to be capitalized, but there's some really specific criteria around that. If it's part of that application development stage, then some of the costs could potentially be capitalized. The standard, I think, kind of mimics the internal use software where you actually develop the software for internal use. Those standards have been around for a while. So it's very similar in its basics. And I think if you read the standard, you'll find that it's fairly user-friendly, and it has some good examples of what it means, what are the implementation costs of a specific cloud computing arrangement. And so again, since we're talking mainly about not-for-profits that are not considered public entities, you're looking at effective date for this fiscal year, December 31st, 2021. Looking at another standard that was also as part of the simplification project around Goodwill. As I mentioned, there's been several of them issued. The 2017-04 simplifying the test for Goodwill impairment is also It's not quite effective yet, but will be. So if you do have goodwill that you recognize on your balance sheet, take a look at this, because it's one of the standards that actually will help with goodwill impairment. It eliminates some of the impairment tests, focus on the lower fair value of the reporting unit compared to carrying value. Negative goodwill is not recognized. Just a few items there to consider. I don't know how many, I don't have the statistics of how many not-for-profits actually carry goodwill on their books. Typically arises from business combinations and so forth. But we are seeing an uptick in mergers and acquisitions around the country due to COVID, due to some of the bankruptcies, but also due to just efficiencies that can arise from mergers and acquisitions. So I think the standard will be more prevalent going forward. Another standard around goodwill is accounting alternative for evaluating triggering events, was just issued this year in March 2021. And the idea is that the triggering event analysis can be performed at the end of the reporting period. You do not necessarily have to do it during the year. So for just some bullet points on this particular standard, because it's just so new and was recently issued, you're not required to monitor goodwill for impairment triggering events during the reporting period. I think this particular standard was issued quickly because of COVID, because the situation was changing so often and so rapidly. So the not-for-profits are now allowed to evaluate facts and circumstances as of the end of each reporting period. And so again, something I think that simplifies some of this accounting and allows not-for-profits to focus on their mission instead of testing goodwill at every possible triggering event, of which I think there were quite a few in the last 18 months. So it's available to private companies, but also not-for-profits. Again, not just a not-for-profit specific standard, and early adoption is permitted. And again, you could see that this particular standard doesn't really quite follow the regular effective date guidance, because it was issued fairly quickly, but you could see early adoptions permitted for both interim and annual financial statements that have not yet been issued or made available as of the time that the standard was issued. So looking at another fairly large standard, as I mentioned before, CECL, the standard on credit losses, ASU 2016-13. This particular standard will impact a lot of for-profit entities, and I think it will have an impact on some not-for-profits, some larger not-for-profits, but perhaps not as widespread as it will be affecting the for-profit sector. So this particular standard requires more timely reporting and disclosure of credit loss allowances. And we'll talk a little bit of what this particular standard tried to represent, well, what GAAP was before the standard and what it ended up being after. But the effective date for this standard is calendar year 2023 and then fiscal years after. So I'm not going to spend a lot of time, just know that it's out there. It affects receivables on your books that stem from mainly fee-for-service arrangements, as well as loans, debt securities, trade receivables, I think is what we'll be seeing in most non-for-profits, and then other financial assets. Promises to give are specifically scoped out of this standard. And so for your contribution receivables, you will continue to apply other guidance that is out there currently. So just quick before and after slide here. Before, loss reserve, so think about your allowance for uncollectible accounts are recognized when it's probable a loss has already been incurred. A lot of times when you're looking at your allowance, you're looking at specific identification method where the information is already present of what particular trade receivables might not be collectible. But with this new standard, the method requires the recognition of all losses expected over the life of the instrument upon the origination or purchase of that instrument, unless the organization elects to record it at fair value. Again, if you elect to record certain financial assets at fair value, you're obviously updating that fair value at year end. But under this particular standard, trade receivables will have to be looked at in a lot more detail based on the historic information within the organization, available information at the time that that receivable is entered into, and the loss reserve would have to be recognized at that particular time. So that, in 40 minutes, I gave you a very quick overview of some of the not-for-profit specific standards that are on the horizon. And we will go through and talk about some of the auditing standards that are changing. And this information probably is more prevalent for the auditors on the call. I know we have several, but also for the organizations, because you will be seeing some of the changes in the actual reporting that the auditors will be providing. So maybe some education to the boards, just so that they are not surprised to see different opinions coming down from audit firms here shortly. There was a whole new suite of auditing standards issued fairly recently. There was a deferral of 1 year on these standards, again, because of COVID. All of these standards were actually, for the most part, were supposed to be effective December 31st, 2020. And then the standard was you could see SAS 141 was issued to amend the effective date for 1 year, but it's looming, it's near here. So all of these standards will be effective December 31st, 2021. The main one is SAS 134, and it's the reporting an actual change to the format of the auditor's report. A lot of times when I present to the boards, I always have to tell them that we kind of have to find that opinion paragraph. Sometimes it's on the second page, sometimes it's even on the third page if there's a lot of different paragraphs added to the auditor's report. Well, the board thought that it would be very important for the users of the financials to know what is that auditor's opinion. And so the format of the auditor's report is changing in a way that the auditor's opinion will be presented as the first paragraph of the report, so that you don't have to go looking for it during your presentation or when the users are actually reading the financial statements. There are some changes to the basis for the opinion. There's some additional information on going concern. Again, you could imagine that that came about also from COVID, even though some of these standards were already in the works prior to that, but it became even more important in the current environment. Key audit matters will be added to the report if they're applicable. There's some specific responsibilities of management that are highlighted. Obviously, the financial statements are responsibilities of management, and the audit firms issue an opinion. And so that particular information is highlighted again. And there's some other reporting responsibilities if they become applicable. So we'll go through and kind of give you a glimpse of what it's going to look like. And again, if you want to read this in more detail, the slides will be available if you want to share it with your boards or finance committee members. So this particular report has been changed to show the various highlighted items that are being added or moved around. So the layout is changing. As I mentioned, the opinion will be the first paragraph on first page of the report. Basis for opinion changes a little bit as well, and the responsibilities of management. So the item here that's was added, you could see it on the bottom of the page, that talks about the going concern. In preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about the organization's ability to continue as a going concern for the specific time period. Even though management has always been required to evaluate the going concern considerations, I think this particular change puts it up front and allows the users, kind of puts them on notice that management is doing so. A couple other changes, you could see the formats changed. There's expanded responsibilities on the audit. Some of this language has already been in the auditor's report, but it's been rearranged or rewritten, so it'll be a little bit different. Couple other changes in the auditing world. So auditor report on ERISA engagements is also changing. And for those of you who have 401k, 403b plans, and you do have those audited because of the ERISA requirements, you'll be also seeing a new report there. A lot of these other standards, 137, 139, 140, have been issued to conform other type of reporting that sometimes auditors do with the auditor's report on the financial statements. For example, you'll see auditor's responsibility relating to other information, including an annual report. So other information could be management's reports, management commentary, annual reports, chairman's statements. They come in all kinds of shapes and sizes. And this particular standard requires the auditor to read and consider whether the other information is materially inconsistent with the financial statements. So for the organizations out there, if you are putting out information like an annual report that will that will actually have some of the audited financial statement information included in that report, please let your firm let us know so that we could comply with this particular standard and review that information before it becomes public. Some of the other amendments here, lots of numbers. You see section 800, 805, 810. All of those sections are different types of audits. So audit of financial statements prepared in accordance with special purpose framework, audits of single financial statements, audits of specific elements, accounts, items. Sometimes we are engaged to perform audits of not the entire set of financials, but only of certain single financial statement or a very specific element. So all of these various new auditing standards align the new reporting with the overall SAS 134. And just quickly, while we still have a couple of minutes, I'll run through these and then see if we have any questions I can answer. 135 aligns of the communication to those charged with governance. As you know, auditors always issue a communication at the end of the audit that is very specific on what items we need to communicate. So there are changes to what items are being communicated, specifically significant unusual transactions, of which we've seen quite a few in the past year, or difficult or contentious matters that need to be brought up to the attention of those charged with governance. So look for some of those changes, and as CFOs and auditors, you will be reviewing those before they go out to the board. The 144 talks about the audit evidence, and this particular standard is interesting because it was also issued as part of trying to get up to speed on auditing in the remote environment. In the past, auditors are always required to assess whether or not the evidence that's provided is appropriate, but this particular standard kind of changes its focus a little bit to also not only understand where the audit evidence is appropriate, but also whether or not it's accurate and complete and authentic because of the ways that the auditing world has been changing in the remote environment. Okay. And then the previous standards all covered audits, but there were also review and attestation standards that changed. So if you're a client or you're an auditor who actually work on review engagements instead of audits or other type of attestation work, just look out for some of these new standards that were issued surrounding materiality and then also agreed upon procedures engagements. Okay, so lots of changes all throughout auditing standards, accounting standards, and I wanted to take just a couple of minutes at the end to show you some resources that are very useful and just to keep up on the standards, but also if you ever want to look at maybe some articles or policy examples that you're looking for. So the top 3 here that I listed is FASB, AICPA, and us, Bailey. So as far as FASB, I already had one snip of their website on the slides. This is another where if you actually go to their website and under news and media, they have educational webcasts and webinars. They just held 2 very recently that are very specific to not-for-profit. So June 14th, Jeff Mechanic, who's the assistant director at FASB, also responsible for not-for-profit accounting, did this presentation on all the updates that are coming down from FASB. And then another one was, again, a very detailed presentation on in-kind. But if you can, please join our event in November, and we'll be talking about some of the changes since June, some of the additional disclosure examples that have come out from AICPA, and we'll cover that standard in more detail. AICPA is another very good resource. They do have a very specific section dedicated to not-for-profits, and this is their landing page, but you'll see that some of the resources are available to non-members, but some of the locked content is available for members only. The content has a lot of information, a lot of examples, policy examples, and also illustrative financial statements for both large and small not-for-profits, and various other resources. I would encourage you to go there and look around. And then for ideally, we also have a landing page. We have not-for-profit is our 4th largest industry firm-wide. So there are quite a few resources dedicated to training and various materials that we put out. You could also search insights that are very specific. We have put a lot of information out around various CARES Act and other type of government relief funding that's been available for not-for-profits, and also the accounting behind it. So if you missed some of the webinars previously, this is a good place to go to find some of the answers, and obviously reach out to any one of us, any of your audit partners or managers, or you could also post some information here on the website and we'll get back to you as soon as we can. So let me see if there are any questions. So one of the questions was for in-kind gift reporting. Does this include putting a monetary value on volunteer hours gifted to the organization? So that particular accounting guidance did not change. Volunteer hours are still not recorded if they don't fall under the criteria that's currently prescribed by GAAP, but it is an elective disclosure. It's not required, but there was actually, I believe, a slide that I had with an example. If an organization chooses to show volunteer hours, you're more than welcome to do so. There's actually a valuation website that you could go to. don't remember if it's Volunteers of America or one of the organizations, but if you search for it, it provides value of volunteer hours in each specific state. So I've had clients that do track volunteer hours in a lot of detail, apply that value, and actually disclose it as such in the financial statements to show the users the impact that volunteers have on your organization. But the standard did not change the requirement to actually record volunteer hours unless they fall under the criteria already previously prescribed by GAAP. Okay. Yeah, and then had some question on whether or not the new NFP reporting of gifts in kind is only for those following FASB. And yeah, I have not seen any GASB guidance on gifts in kind. The standard was specifically issued for not-for-profits that follow FASB. And let's see, and then I think we had one more question that came through. What's the definition of significant unusual transactions? You know, I actually won't be able to answer that right off the bat, but if I will be able to reach out to you after the fact and can look into that standard a little bit more. I don't remember the definition off the top of my head right now. Any other questions? I think I answered all of that, and then Amy did provide a link to the materials. And if you're reviewing the materials, if you're looking at the lease entries or other slides that you come across that you might need a little bit more information, please reach out. My contact information is here. Again, I reside in Colorado office, but we have members of our technical issues committee for the firm sprinkled throughout various offices. So we'll be able to get you an answer fairly quickly.